Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. Higher gas prices, sticky inflation, and shifting consumer habits have kept markets focused on one question. Is the US consumer finally starting to crack? But our next guest says the real story isn't about whether consumers are spending less, it's about where they're spending differently in many cases. From the surprising battle between pizza and tacos to why customer service is back in focus, and what travel demand is revealing about household resilience. Joining us here today to discuss the trends shaping consumer behavior is David Cochrane. He is Equity Research Analyst and Associate Portfolio Manager. Warm welcome to you, David. Good to see you again.
Thank you for having me.
Time to check in on what we're all going to do this summer and what it means for investments so far. So let's begin there. Let's begin ultimately with what we've all been dealing with, which is higher oil prices. The obvious question is, how is that crimping everything else? And first of all, is it crimping everything else?
Well, that's exactly right. That's the big question from a macro perspective in consumer right now is, as I'm sure you've noticed, prices at the pump are up over 30% in recent months, and whether that is going to weigh on consumer spending in other areas because they've spent all their money on gas. Right. So maybe just a little context around it, and then we can go into what we've seen.
Sure.
So for reference, consumers in the US spend approximately 3% of their after-tax income on gas.
It doesn't sound like that much.
It doesn't sound like that much, right? And so you go, okay, it's up 30%, so maybe that's a 1% headwind, but that's not exactly the way to look at it, because the issue is, I guess, lower income consumers spend a higher percent of their income on gas, and that's 3% of your total income, but you still have to pay rent, you still have to pay for insurance, you have a bunch of non-discretionary expenses. Mm-hmm. So if you looked at the wallet of a lower income consumer and just the discretionary piece of that, the impact can actually be multiples bigger.
And let's just layer in there, to what extent, I mean, of course, you're looking at sentiment measures, that's part of what you're going to do, but it's very interesting because everyone's grumpy, everyone's unhappy, everyone has, sentiment is poor if you sort of anecdotally look at it. But how do you look at that, and do you put it to one side when you're measuring?
Well, that's right. So we like to, first, we're certainly bottom-up stock pickers, but when I'm looking at the macro picture, I like to look at sentiment indicators, but I also like to look at the data. So people can be grumpy, but are they still spending?
Right.
And so what we've seen so far is really a limited impact. US household spending on non-gas and non-autos was up 4 or 5% in March and April, despite the higher oil prices. We have access at Fidelity to some more real-time credit card data, which shows things have slowed a little bit in May, but are still running at close to 4%. Canada, we have the data on a lag, but Canadian consumption was up 4-ish% in March as well. So we really haven't seen a fall off, particularly in the US. Now, there's a nuance around this, and the nuance is the consumer in the US has been benefiting from a tailwind that it was driven by higher tax refunds.
Right. And that's the month of May, really. Sort of the story of the month of May and the anticipation of it.
Well, so certainly in March and April, I've seen an estimate that the US consumer had a $45 billion tailwind from higher tax refunds year over year. And so you can look at the data and say, well, the consumer hasn't really slowed till this point, or maybe slowed only marginally in certain pockets, but you were benefiting from this tax refund tailwind. So what happens if gas prices stay high, and then does that eventually start to show up more in consumer spending, particularly for this low-income consumer?
Okay, so we'll talk about that. We might also talk about what if gas prices actually come down quite a lot, which apparently could be
I think it's all within the spectrum of possibilities, okay. Right? And so our job at Fidelity is to understand, okay, basically deeply understand our companies and their exposures. Who are their customers? Right. How sensitive are their customers? How sensitive from a macro perspective or discretionary are the goods you're actually selling? And then what does it mean if your consumer pulls back? What's priced into the stock? What does that mean for earnings and ultimately the stock price? And so we're trying to understand those macro sensitivities. That's a first piece of it. But we're also trying to understand which companies are winning and losing regardless of the macro,
And have
right?
pricing power.
And
yeah.
so you need to be able to understand the company's specific drivers, because if a company comes out with a weaker set of results and says, hey, we're seeing a macro impact, maybe they are, but maybe there's something else going on. And maybe there are companies that can just thrive even if the lower income consumer is weak, because they're winning a lot of share with that consumer. And so we're trying to separate all that out and find the best stocks within it.
I mean, I wonder if you can just sort of put it into perspective. If you look at the United States, Canada as well, I mean, most so-called developed nations are highly dependent for their economy on the consumer, right? I mean, the consumer has to spend or the economy doesn't work, essentially. I mean, there are lots of other components, obviously. But this is incredibly important to the functioning of an economy. So I'm just sort of wondering if you can put that in place of where we are, compared to coming out of COVID. What is this moment for consumer spending, even though we're grumpy? I know we're grumpy.
I think the analogy people like to make is looking at the 1970s oil shock.
Yes.
But I think one of the important things to remember is consumers were spending a much higher percentage of their income on gasoline at that point. Mm-hmm. And so we're less sensitive today to this, but you're right, it is still an important piece of the picture. I think what you need to look at again is just the consumer spend curve will ebb and flow. You have headwinds and tailwinds. Last year we were talking about government shutdowns, slowing wage growth for the low-income consumer. You had ICE, which had impacts in certain populations. So you had all kinds of headwinds last year as well. And there's always something going on.
Sure.
So it's really, okay, how does this compare to last year? Is this transitory? Is this going to ebb and flow versus a big structural issue?
So there's probably more to understand on the exposures to various headwinds, essentially. And we can ask you about that. I wonder if you can throw out an example or two of where you see this. So
Yeah.
Across the consumer story, where are people spending on services, on stuff?
Well, I think it comes back. I'll give you the example of competition within restaurants. Mm-hmm. And restaurants,
restaurant companies,
companies. And so restaurant companies, I mean, they have a broad exposure, especially quick service restaurants, including low-income consumers, right? So there's kind of an interesting example of the pizza category versus the taco category. And I'll give you the example where pizza is really struggling. And if you looked at the first quarter results, Domino's reported 1% same-store sales growth. Their delivery business was actually down. Their competitors, Pizza Hut and Papa John's, their same-store sales were down mid-single digits in the US. And Domino's will talk on their call about how, yes, we're seeing some macro impact in the low-income consumer. And so you go, okay, is this just macro? But I think when you step back, you realize competition has massively increased for the pizza category. When I was a kid, and look, I still love pizza, but if I wanted to have something delivered, the only option was really pizza. And with the rise of DoorDash and Uber Eats, you have all kinds of different delivery options now.
And less pizza players even at that point.
Yeah. And so you're starting to see, I guess, just competition within the category and the category mature and promotionality increase. So you can look at it and the explanation will be partially macro, but part of it's just something that's company or subsector specific. And you can contrast that with Taco Bell, which is owned by Yum. Mm-hmm. Taco Bell in the first quarter grew their same-store sales in the US 8%, and that's against 9% compare last year. And
wow. What are they doing?
I mean, they have a tremendous combination of menu innovation, value, a growing digital business, and the brand is just really resonating with consumers. And so I think that's a contrast where we can talk about low-income consumer, we can talk about macro, but the Taco Bell customer and the Domino's customer are not necessarily that different, and one of them's thriving, or one of the companies is growing quickly, and one of them is kind of battling amongst smaller competitors. And I think that's the important contrast. And so we're trying to figure out what's macro, what's company specific, what does it mean for what the companies will earn, and what does it ultimately mean for the stocks?
That's incredible. In terms of, do you want to get into just sort of the valuation story a little bit? I mean, how are these being treated by investors at this point?
So consumer discretionary is a subsector where or as a sector rather, where there's high intra-sector dispersion. So you have these big winners and these big losers, almost regardless of the macro backdrop. And I think what you're seeing is companies that have any sign of a structural type competitive headwind get punished very quickly. And companies where trends inflect, the valuations re-rate very quickly. And so it's important for us to pay attention to these inflection points and try and own the winners before you see this growth show up. And so you can capitalize on the higher earnings growth and the re-rating and valuation.
For some time, they would look at, for instance, the luxury segment of that being kind of recession-proof. I mean, I don't know to what extent any of that stuff holds, but it has shifted within what we used to think of as the consumer being okay through this economic situation. Untouchable here. The disruption of technology, delivery, I guess, is a good example within food. How has that shifted? What is or isn't holding pricing power? Is it the higher segment, the lower segment, or is it innovation?
I think it is that higher segment has pricing power and it's innovation. And I'll give you an example of this is another area within restaurants, but I think it's a broader consumer trend, which I believe the era of customer service is back, right? And you're seeing this show up within the beverage segment. So in restaurants, one of the fastest growing segments is cold beverages. Think cold, customizable, sweet coffee.
Even in January.
It's
just unbelievable. Like, really, you don't want a hot drink?
Nope, that's it. And so those are, I guess, that's the fast growing category. And you've seen a couple players in the US. The two notable ones are Dutch Brothers and Seven Brew, which is a private company, grow very rapidly. And part of the magic is, yes, we're operating in this category, which is great. But part of the magic is they're bringing back customer service.
They're friendly with a smile.
They're friendly with a smile on their face. They'll come out, chat you up. And it sounds like a small thing, but relative to your average quick service restaurant experience, it's differentiated and resonating. And these are no longer small players. These two companies are up to approximately 2,000 units in the US. And so what you've seen is some of the bigger companies take notice and try to do the same thing. And the best example of that is Starbucks. So Starbucks has a new CEO.
They've been trying a lot of new things lately.
They've been trying a lot of new things. And I think you'll remember Starbucks in the 2010s, it was friendly service, write your name on the cup. And they kind of lost their way a little bit, have brought in a new CEO, Brian Niccol, who's the former CEO of Chipotle. And his plan is all about this customer service aspect. So he's reinvested hundreds of millions of dollars in store labor. They have new training programs and measurement programs to try to increase hospitality. They're bringing furniture back to Starbucks. And what you've seen is the same store sales growth start to turn the corner. And so this hospitality element is working. This isn't a comment on Starbucks stock. I think you could argue a high degree of continued success is priced in or expected at this point. But certainly it's hard to argue with the idea that bringing back hospitality is making a difference. And I think that's a broader consumer trend.
Is that still like hangover from COVID where people had to be very sort of dine and dash type feeling where you had to take off with your mask?
I think it's part of that and the temptation certainly to lean in very aggressively to order ahead and the pickup lanes and use the app and you come in, as you mentioned, and pop in, grab it, pop out. But what do people really want? I think they're looking for more than just the beverage itself. They're looking for a smile, positive interaction.
Especially when they're $7 or $8.
Exactly, and that's part of it. So if you have that kind of hospitality, you can charge a higher price and you hold pricing power to your original question.
That's so interesting.
But yeah, that's an element of it that, I didn't think we'd be talking about necessarily, but we're seeing it work.
Manners matter.
Manners matter.
Manners matter. That's nice to hear, actually. That's a nice new development. Let's take it into sort of the summer travel season. So probably restaurants are part of that and drinks along with it. But this goes to hotels where people will stay. They're expensive, but which ones hold the pricing power? The bigger the better? Is that still the case?
The bigger the better is for sure still the case. I'll run you through maybe just to compare to where we were last fall. So when I was
Okay.
on the program last fall, I think we were talking about how revenue per available room night,
Yes.
which is what a hotel on average gets per room they have per night, that was falling and it actually running negative last year. And what we've seen to start 2026 is, particularly in the US, revenue per available room night has accelerated. That growth has accelerated. It's now positive. And interestingly, the biggest change was in that low-income consumer. That economy segment, that RevPAR acceleration has been the most dramatic of any of the chain scales. And
So the chain scales will have their luxury version,
yes,
and then their more economy
that's
stuff,
right.
and that's where they've seen a lot of growth.
Yeah, and so you've seen
Okay.
that really turn around, which is interesting. And I was speaking with our industrials analysts who cover the airlines. They were talking about Canadian Airlines and what they're seeing, because if you've tried to book a flight recently, certainly they're trying to pass on these higher jet fuel prices. And they really, it sounds like, haven't seen much of a fall off in demand. And we certainly have a great data set in the US, which shows passenger traffic. And it's the same thing. It's tracking right in line with normal seasonality despite higher prices.
That
So
is like classic, everyone's complaining but still spending, isn't it? I mean, that's right there.
it's one of those examples, right? And so you're seeing it in travel. And so what does it mean for the stocks? I mean, when we were on, or when I was on in the fall, we talked a little bit about how the big get bigger in hotels.
Mm-hmm.
The two examples being Hilton and Marriott, who grow rooms at, call it, 2 to 4 times the rate of the market. And that has really continued. The big keep getting bigger. And with this turn in revenue per available room night growth, the earnings outlook has improved and the stocks have done very well and re-rated, and that's been kind of the story of travel to start 2026.
I mean, that's very positive and really interesting, and for investors, extremely important place to look. What's the why behind it? I mean, you could argue last year and in the last little while in the US particular, we keep hearing that foreigners are not spending their tourism dollars going to certain places. People are being more domestically focused. I mean, does it matter if that, it clearly doesn't matter if that's true or not, but what is the why behind seeing this rise?
I think particularly if you look at the economy segment within hotels, so that lower income consumer in the lower chain scale hotels, they had a lot of headwinds last year as well. I mean, Democratic consumer sentiment was in the tank. Lowest quartile wage growth had slowed more dramatically than other quartiles. You had a government shutdown, which, there's disruption to government paychecks as part of that, but also just government themselves for business purposes. There's a bunch of travel related to that. So you did have a bunch of headwinds last year. And as you start to lap those, yes, gas prices are higher, but the summer travel impulse is kind of back. And you've seen, just as you're lapping a softer period, yes, we have some headwinds now, but we had headwinds last year, and RevPAR was negative last year, and you've seen kind of a mechanical flip to positive RevPAR growth.
So it was troughing for all of those reasons, but there's a bit of a trough and the climb is back. Let's ask you a little bit about how many of the companies that you would take a look at, how they are reacting or maybe no longer reacting to the story of tariffs. That was a huge headwind. Everyone was scrambling, and Fidelity doing an incredible job of figuring out what the exposure was to various tariffs. They kind of been canceled. There's new ones being put in. Where do some of the companies you follow sit? I mean,
it feels like the Iran war dominates the headlines every day, but there is plenty going on with tariffs still.
Yeah.
So maybe,
you don't really hear about it, actually.
It's not the first article now versus it was the first article, but that doesn't mean that there's not change in news. So a quick update versus last fall. Actually, I'll take you to last April. So that was President Trump, Liberation Day, holding up his tariff rate sign. So those tariffs moved around a little bit in a negotiation. But those tariffs were known as IEEPA tariffs. And in February, the US Supreme Court ruled that President Trump does not have the authority to impose IEEPA tariffs. And they ended up actually being turned off, and companies are pursuing refunds for those.
Because they were emergency tariffs that
Yes.
were meant to fight
Emergency
emergencies.
economic tariffs. And they were shut off. Companies are pursuing refunds. What President Trump and his administration ended up doing is imposing something called Section 122 tariffs, which fall under the Trade Act of 1974. These tariffs actually were a step down. Big round numbers call IEEPA tariffs 20%, 122 tariffs 10%.
Okay.
So tariffs actually stepped down, and we're currently under this 122 tariff construct. And the nuance with them is 122 tariffs only last for 150 days. And so they expire in July.
Wow. Yeah.
So the big question is, okay, what's going to happen in July? The expectation is that 122 tariffs will be replaced with something called Section 301 tariffs, also fall under the Trade Act of 1974. There's some, I guess, complications with how you need to impose them. But the question is, okay, what rate are those going to come in at? Is it the 122 rate? Is it the IEEPA rate? Is it something lower, higher? Do they come in right away? Is
Can
there a
companies
break?
swallow them? Do
And
they need to pass them on? Yeah.
Well, that's it. And
Yeah.
so what we're doing here at Fidelity is we like to understand, okay, how exposed are our companies? Where are their where do they procure their goods from? What do their supply chains look like? What is their pricing power and ability to pass on tariffs? What have they built into their guidance? And this is all in an effort to understand, okay, when we understand what happens when Section 122 tariffs roll off, what are the earnings going to look like? What does it mean for the stock? And we want to have done all that work ahead of time. And it's labor intensive, but the part about Fidelity is we have a big team of people. We have phenomenal access, and we're all doing our work, doing our modeling to understand basically where are the exposures and what does it mean in terms of what we should own.
And you can limit the surprises that come along.
Yeah, you want to understand your exposure
yeah.
ahead of time, and you want to be in a position to pounce if it creates any opportunities.
It's really, really interesting how all of this kind of comes together. And July, of course, is when we think in Canada, CUSMA, USMCA is going to, I mean, we don't know if it's going to be renegotiated. Everyone keeps saying July 1st is not going to happen. But in any case, the timing dovetails with a new era of tariffs. And you now need to know what you know about some of these being slipped into an actual trade deal, or to what extent that's going to affect the overall story.
July should certainly be exciting. So the USMCA is currently up for renegotiation. In theory, the three countries need to settle on an agreement in July, and they have three options, which are extend the agreement under its current construct for another 16 years.
Which we'd like.
Which, hey, wouldn't be a bad outcome.
But apparently isn't going to happen. Yeah.
They could move to a basically annual review for the next 10 years, or they can elect to walk away with a 6-month notice period. Now, Trade Representative Greer has suggested they don't want to basically blow up this deal in its entirety, but it'll be a negotiation. And so if you look at the US's goal is to increase manufacturing in the US.
Yeah.
And
you just start there.
You start there.
Just start there.
And then Canada and Mexico's goal is to keep free trade open, but also to perhaps lower the sectoral tariffs that have been imposed on certain areas, steel, aluminum, copper, forest products. And so that is basically the starting point for the negotiation. I think, Trade Representative Greer has there's been some indications in the news just that the U.S. would basically like to increase the restrictions around content origination rules, which is basically, hey, you can't ship something from China to Mexico,
right, and then
ship
put it
from Mexico to the U.S. and say, hey, this is from Mexico, no tariffs, and keep those manufacturing jobs in North America. But this will be an evolving negotiation. And so how do you approach it? You do the same thing you do with tariffs, right? Yeah. Which is understand your exposures, understand the earning sensitivities, know where you are, know how to react.
So to what extent from tariffs, and now in anticipation of, we don't know on the trade front exactly, Have supply chains, have companies shifted? I mean, they were getting kind of used to shifting out of COVID, more robust in that sense to deal with new shocks coming along. But you imagine there's some real preparations. Can you give us a little bit of an outline or an example of what that has looked like?
Sure. So you're right. I think companies have built a muscle around being able to adapt their supply chains more quickly than, it's really not something they necessarily faced in the past. A great example of a company that's done a good job of this is Aritzia.
Okay.
So Aritzia has figured out, this is a women's apparel retailer.
Oh, we know. Yeah.
You're familiar. I've talked
Three
about
daughters.
it on this show before.
I know.
Beautiful new store in the Eaton Center, by the way.
Oh, is it? Okay,
Yes.
I'll try not to visit. Yes.
Must check it out. And they've done a great job at basically figuring out how to procure goods from a number of different countries, working with a number of different suppliers, and ultimately mitigate some of this tariff impact. They've also, the brand themselves and a more everyday luxury is a brand with pricing power. And so they've done a good job, I guess, navigating tariffs. That'd be an example.
That's a great example. Let's talk a little bit about those that are homeowners. Just like gas prices and what you do, these are costs that stick with you. Your mortgage in the U.S. Talking a little bit about the consumer for home builders. You're thinking of where you're going to buy a new faucet if you're going to be renovating your house one way or the other. They're all connected within the housing story and can be quite cyclical. Do you like those areas of consumer buying or not? What are the headwinds / tailwinds?
I mean, this story. So some of the larger companies in the U.S. are kind of home improvement retailers, with at least within the consumer discretionary space. And I think
cheap cleaning products too, I've noticed.
Cheap cleaning products
yeah,
there?
It's a good place to go for your
like it.
bleach
I like
things.
It. What the story really of housing in the U.S. has been a continued depressed environment for housing turnover.
Okay.
So in the U.S., housing turnover is running at about 4 million homes. Pre-COVID, for reference, that was 5.5. In COVID, it went to over 6. And the issue really has been rates, right? And in the US, you have this construct of the 30-year fixed mortgage. And in Canada, we can have longer amortization periods, but you can't lock in a rate for 30 years.
Which means people can move.
Which means people can move, but also if rates go up, you feel the impact sooner. Yeah. So mortgage rates have remained high in the US, and part of it is this inflation concern. And does that mean rates need to stay high, which is also a function of energy prices? But the, I guess, higher mortgage rates have prevented housing turnover from picking up. And what it's meant for the stocks is, the stocks were actually trading at healthy multiples in anticipation of a bit of a recovery.
Right, because rates were projected to come down.
Exactly.
This was the time.
The recovery has not showed up. I mean, activity is low, the recovery's been pushed out, earnings estimates have been cut, and the stocks have come off. And, I think where we are now is, hey, when is this going to happen? So that's basically the story of home improvement.
So what
retailers.
do you do with that? I think we were speaking with one of your colleagues recently and sort of trying to get a handle that if there is to be hikes or holds, or we're not sure in the US, nobody really knows, in reaction to inflation, is it a cycle, or is it just sort of a hike or two? Nobody really knows. But I guess the question is, what's the impact of that not knowing for these types of companies?
I think what you're trying to do is assess the risk reward in any scenario. So, back in the fall, these stocks were trading at elevated multiples.
With anticipation
of recovery. And you say, well, if there is a recovery, how much upside is there to the stocks? And if there's not, what does it mean? And what if it takes longer? And so I guess being careful from a compliance perspective, but you'll see we haven't owned the stocks. So that's what you do.
So that is the expression of how we feel about
just
that.
Just trying to understand the risk reward.
Yeah. Okay. It's interesting. Is one of the trends, if people have house turnover, then they renovate and spend big bucks at places like that?
Exactly.
And if they don't, because then there was also the argument, I think during COVID or other times, where no, we're going to stay here, but we'll put a new bathroom in or whatever.
That's also the case. You're right. So it's kind of both things.
But rates are still one of the pieces that go into that calculation.
That's right.
You have a new job, actually. I mean, you're still doing exactly what we're talking about, but you have also, congrats, been named to a new position. You want to tell us about that?
Sure, yes. So I've been named as the Associate Portfolio Manager on the American Equity Fund. So I'll be working with Darren, who was recently named the lead portfolio manager on the fund. And I'm absolutely thrilled for the opportunity and to work with Darren. I think we have very complementary styles, both look at the world in a similar way. You know, we're trying to own higher quality businesses with durable growth runways who win market share, expand margins, earn high returns on capital. And we're trying to own those companies in periods where things are inflecting and there's upside to earnings estimates over kind of medium and longer term bases, and the risk rewards are attractive. And so I think we both look at the world in a very similar way. You know, my role will be to be basically another funnel for him for ideas and for portfolio position monitoring, and particularly focus on the areas of consumer, of course. But
I was going to ask you which area. So this is currently where you're. You've also done. Is it tech?
Yes, so I've previously covered tech, communication services, internet, a bit of media. And so within that area as well, I just hope to help Darren out. And, you know, we've worked together for a long time in my capacity as an analyst, but excited to work even more closely with him in this role.
That's great. When did it begin? How long ago?
It was announced 2 weeks ago.
Oh, so it's brand new. Okay, well, thrilled for you, and that's great. Good luck in your new role. Thank you for talking us through some of the pieces of what's going into investments across the consumer space. What would you like to sort of leave investors with on this note, that either you're watching or the pieces that come together in the next little bit? What's a final thought from you?
I think the important thing to remember is that the consumer will ebb and flow in terms of health. But what we're looking to find is those companies that are underappreciated, that are winners regardless of the backdrop, and trying to separate what's happening from a macro perspective versus what's happening from a company specific perspective, and own the right stocks that are kind of winners there.
Pizza or tacos? What would you spend your money on?
You know, I love both, and I need to spend more money on salad.
Okay, go. Gotta find the investment for that too. David Cochrane, thanks for joining us.
Thank you for having me.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.